As a bank that focuses on business, we work with business leaders all day, every day. We have a front row seat to what's working and what has potential. The First Business Bank podcast is dedicated to sharing insights to help you work better, smarter, and faster to achieve your goals. Let's get into the show.
Welcome to the First Business Bank podcast. I'm Brendan Freeman, and I'm the president of Private Wealth at First Business Bank. I'll be your host today for our podcast where we explore the dangers of emotional investing and how that can play into your investment decisions. To go through this topic with me today, I've invited my colleague, Matt Krutza, who's our director of private wealth and a wealth advisor working with individuals, families, and other organizations to join me. Matt, would you mind taking a moment to introduce yourself to our audience?
Yeah, thanks, Brendan, and thanks for having me on this morning. Matt Krutza, Director of Private Wealth here at First Business Bank. I have roughly over 13 years of experience in the wealth management space. As Brendan had mentioned, I act in a dual role here at First Business Bank, serving as a wealth advisor for clients, but then also have a team of wealth advisors that I manage and just work really closely with clients, individuals, companies to make sure that we can meet and exceed their expectations in terms of their goals and dreams. So thanks, Brendan, for having me today. It's a pleasure.
Great, Matt. We're glad you're here today. Thanks for joining me. As the title of our podcast implies, many investors can get caught up in emotional decisions when it comes to investing. And so I want to dig into this a little bit with you and hopefully with a lot of the information that's out there, maybe put some of our listeners at ease by following some of the things that we dig into. So fear of making a big mistake can oftentimes take over when you're thinking about investing, and it can lead to a lot of challenge emotionally for clients and investors. In fact, one study shows that 66% of investors have made some type of impulsive or emotionally charged investment decision that they later regret. And almost half of investors report having trouble keeping emotions out of investing. So with that as our backdrop, I think it's important that we dig into this subject. And so, Matt, if you don't mind, let's just start and maybe just talk a little bit about why it's important to avoid emotional investing decisions as a long-term investor.
Great question, Brendan, and thanks again. And I mean, I think when everybody can relate to this in a lot of ways, when you think about a lot of the uncertainty that we've seen in the marketplace, not only recently today, but going back, really over the last 15 years, 2008, you think about the financial crisis, 2020, the global pandemic, where all of us, I think, were thinking about, okay, what is the next day going to bring? Last year, we had the unsettling disturbance between Russia and Ukraine and the war. And then really, as it sits today, any kind of information that anybody reads today, it's all about inflation. And so these times of uncertainty happen frequent, and that certainly brings up, an emotional time in our lives and where we can and sometimes be prone to making emotional decisions. And as it relates to investing, that can be critical. The risk of making investment decisions based on emotions, for example, with fear or greed, can make it extremely difficult to stay on track and ultimately achieve your long-term financial goals. So we know that fear and greed are two kind of really dominant emotions that often drive investment decisions. So fear can grip investors during the market downturns, leading to at sometimes panic selling and forgetting a previously laid out, oftentimes well thought out long-term financial plan. One example of this, Brendan, I would say is, kind of financial 101 in the sense of how you make money from a market perspective. We know two things. Number one is, you make money when you buy low and you sell high. And when you're dealing with emotions, your thought process can actually be reversed. And so when you make an emotional and invested decision, oftentimes you can be in a situation where you're actually buying high and selling low. And so again, just in turn, it really makes it difficult to really achieve, track, and adhere to that important long-term financial goals that clients have.
Well, thanks, Matt. I guess I'd wonder, how can an investor stay disciplined and stick to their investment plan, especially when things get shaky and uncertain and volatile?
Yeah, it's a good question, Brennan. I would say three things. Number one, probably the most important thing is stay with your plan. Stay committed to it. When we work with clients and we talk about putting that plan and developing that plan, there's a lot that goes into it, and oftentimes it's around what their goals are, what's important to them, what their values are. So a couple examples I would share is, values are around independence or family or certain experiences that they want to accomplish as they get older in life and ultimately retire. Or maybe it's being able to provide the means to money for their kids in college education. Maybe retiring at age 58 as an example, or an annual trip to a great place like Hawaii. Those are great things that we talk with clients about and building out, their customized plan. And so there's emotional attachment to those plans, and reminding clients that um, staying true to that plan, not making emotional decisions that would uproot the potential for us to meet success with that plan, I think is extremely important. I would also add to that, Brendan, that one thing we can do is to test that plan over time, right? Stress tested is like what we like to call it, and there's multiple ways that we can do that to ensure that certainly we can't plan for every unexplained or uncertain event that's set to come our way, but we can kind of prepare for the unexpected the best we can. And so I would say that to stress test that plan is also important. The second part I would say is stay disciplined. Just like anything else, if you stay disciplined over time, good things are going to happen. And the same is true in investing. So I think systematic investing can be extremely advantageous for clients. Dollar cost averaging is one thing that we strive and educate our clients on. And really all that is, Brendan, obviously is just making sure that clients put the same amount of money in every month and slowly but surely kind of build towards those goals and aspirations that they have, and meet the plan and what they want to accomplish. So that's really important, staying disciplined. And then the last thing I would say is managing and checking in on your portfolio. And that's really kind of twofold. I would say number one is know your investments and why you're in them. You should know that. And then the second part is meet with your advisor or your financial expert at least on an annual basis to update your financial plan. That is so extremely important because things change. We all can relate to that. There's material changes that happen all the time, and as a result of that, our risk tolerance changes as well. And so meeting and updating that plan is extremely important to make sure that as we evolve and get closer to retirement, that we're doing the prudent things to make sure that our plan is successful.
Matt, it all sounds so easy, right? But it's the execution on it that really matters. And I think about, how many of us might, during volatile times, just not open the mail or just not check in on the account. And so you bring up some great points around discipline and around really checking in and making sure that your investments are doing what you think they should be doing. To that point, I guess, what are some strategies for diversifying an investment portfolio to reduce risk as you think about it?
I think the biggest thing, Brendan, that you can do or what clients can do is plan out their investment strategy. There's one thing in particular, a successful investment strategy begins and kind of starts with asset allocation. So making sure that within the portfolio, there's a mix of assets, whether it's stocks, bonds, cash equivalents, alternative investments that are appropriate for the client's long-term objectives. The asset mix should reasonably have expectations for risk and return, and use diversified investment strategies to avoid exposure to unnecessary risks. And so recognizing that turbulence in the market happens, your investment strategy can include guidelines with that in mind. And for one example I would give you is a core and satellite approach where investments are buy and hold principles for most of the portfolio, and it's combined with tactical investments based on shorter term market outlooks. So diversification can sometimes work to offset risk of certain holdings. While it does not mean guarantee profits or prevent losses, diversification can certainly help. And again, that's where a clear investment strategy, Brendan, can really be beneficial for clients.
I get it. Yeah, with the core and satellite approach, kind of having that core diversified portfolio, but then maybe based on some, and that's a longer term portfolio, but then maybe based on some things that might be going on short term, perhaps even with smaller dollar amounts of the overall asset allocation, utilizing those tactically. I've seen that approach, not for everyone, but that's certainly an approach. And I think defining that, understanding it, and if that's what you're doing, sticking with it is important. And that's what you're trying to say.
Yeah, exactly.
How about like really getting under the hood here? What are some techniques that investors can use to evaluate the quality of their investment decisions?
Yeah, this is an important one, right? Because you want to make sure that how you're invested is the right investments, and I think it goes back to kind of inspect what you can expect. Which the best way to do that, I would say, Brendan, is making sure that you compare your portfolio, so the asset mix that's within your portfolio against other market benchmarks. That's extremely important. As I might have mentioned, asset allocation is the primary driver of portfolio returns that we as investors can control. So with a well-diversified portfolio, again, that includes multiple asset classes, try comparing the overall performance of your portfolio to other benchmarks. That way you can have a good and better sense of understanding whether your investments are performing and how they're performing in comparison to a peer group. That's critically important. We do that all the time with our clients, and so they can see how we have them invested, and again against a peer group to making sure that what we have is well suited for a client.
So we're living in a really uncertain time, and kind of going back to the title of our podcast and this emotional part for clients with all this uncertainty. What do you recommend given everything that you just mentioned?
I think we all can relate that money can be emotional. So I think it's okay. I would tell clients it's okay to be emotional. Just change the emotion. Remind clients that, of their goals and their values that they've kind of outlined in their financial plan, and stick to the plan that they developed. So again, it's okay to feel a certain way and have emotion, but just making sure that you have a plan and kind of, again, control what you can control. I would say that would be the biggest thing, Brendan.
Yeah, that's important. It's hard to do, as we
Yeah,
talked about,
yeah.
but important to remember. So if you had to leave our listeners today with one piece of advice that they should learn from this podcast, what would that be?
I think there's a lot of things out there that you can't control. I mean, we've covered, there's certainly some big things that happen either annually or, that I mentioned, the crisis, the pandemic, the war. There's a lot of things that we can't control that, quite honestly, scares the heck out of everyone, including myself. But what can you control? I think it's a lot of concepts in life. The key to successful management and investing is control the things that you can control, and make sure that the things that you can't control, that you've tried to test those the best that you can. And I'll give you one example, Brendan. If you watched the Olympics back in 2008, there's a famous swimmer, Michael Phelps, that we all probably remember, and he lined up for a 100-meter butterfly, and he got on those blocks. And early on, you could tell, the announcers could tell that something was not right. And in true Michael Phelps fashion, right, he wins the race. He gets out, and you could see him turn to his coach and his family, and you could tell something was wrong, kind of pointing to his goggles. And we found out, sure enough, that his goggles had broke, and sure enough, he had still won the race. He came out with an autobiography. A couple years later, we found out that the key to the success that he had was that he didn't panic, and that he had prepared for the unexpected, and that he had actually raced that race over 100 times. He knew exactly how many strokes he needed to win that race. And so although you kind of look and you're like, how in the heck did he win that? He planned for the unexpected. And although we can't, plan for everything, there are ways that you can kind of plan and test your plan compared to the unexpected. And so that's what I would say. Control what you can control. Know that there's things that out there that we can't control, but just be prepared and just go in it with a clear mind and control what you can.
What a great story. I love it. Excellent discussion today, Matt. Thank you. We covered many elements of a topic that I think a lot of our listeners can relate to. And certainly in uncertain times, it's definitely prevalent, and emotions can really kick in for many of us. And so thank you for that discussion. Thanks for being our guest today, Matt. I also want to thank our audience for listening to this podcast today. Be sure to visit firstbusiness.bank, our website, to check out other resources that we offer for business owners and for investors. And we invite you to experience the advantage at First Business Bank. If there's any way we can help, please reach out to us.
If you want more content like what you just heard delivered straight to your inbox, go to firstbusinessbankpodcast.com. And if you haven't already, make sure to subscribe to the First Business Bank podcast wherever you listen to podcasts. If you're listening on Apple Podcasts, please leave a quick rating of the show. Thanks so much for listening. First Business Bank, member FDIC.